Chapter 6. Still more about the fourth dimension. The financial community's appraisal of a company's own characteristics is an even more important factor in the price-earnings ratio than is the appraisal of the industry in which the company is engaged. The most desirable investment traits of individual companies have been defined in our discussion of the first three dimensions of a conservative investment. In general, the more closely the financial community's appraisal of a particular stock approaches these characteristics, the higher will be its price-earnings ratio. To the degree by which it falls below these standards, the price-earnings ratio will tend to decline. The investor can best determine which stocks are importantly undervalued or overvalued by a shrewd determination of the degree to which the real facts concerning any particular company present an investment situation significantly better or significantly worse than that painted by the current financial image of that company. In making a determination as to the relative attractiveness of two or more stocks, investors often confuse themselves by attempting too simple a mathematical approach to such a problem. Let us suppose, for example, they compare two companies, the profits of each of which, after careful study, appear to afford prospects of growing at a rate of 10% a year. If one is selling at 10 times earnings and the other at 20 times, the stock selling at 10 times earnings appears cheaper. It may be. It also may not be. There can be a number of reasons for this. The seemingly cheaper company may have such a leveraged capitalization, interest charges, and preferred dividends that must be earned before anything accrues to the common stockholder, that the danger of interruption of the expected growth rate may be much greater in the lower price-earnings ratio stock. Similarly, for purely business reasons, while the growth rate would seem a most probable estimate for both stocks, nevertheless the chance of the unexpected upsetting these estimates may be considerably more for the one stock than for the other. Another far more important and far less understood way to reach wrong conclusions is to rely too much on simple comparisons of the price-earnings ratios of stocks that seem to be offering comparable opportunities for growth. To illustrate this, let us assume that there are two stocks with an equally strong prospect of doubling earnings over the next 4 years and that both are selling at 20 times earnings, while in the same market companies which are sound otherwise but have no growth prospects are selling at 10 times earnings. Let us suppose that 4 years later the price-earnings ratios of stocks as a whole are unchanged so that generally sound stocks, but ones with no growth prospects, are still selling at 10 times earnings. Let us also suppose that at the same time, 4 years later, one of our two stocks has much the same growth prospects for the time ahead as it had 4 years before, so that the financial community's appraisal is that this stock should again double its earnings over the next 4 years. This means it would still be selling at 20 times the doubled earnings of the past 4 years, or, in other words, that it had also doubled in price in that period. In contrast, at the same time, 4 years after our example had started, the second stock had also doubled its earnings, just as had been expected. But at this point, the financial community's appraisal is for flat earnings in an otherwise sound company over the next 4 years. This would mean that owners of this second stock were in for a market disappointment even though the 4-year doubling of earnings had come through exactly as forecast. With an image of no growth in earnings for the next 4 years, they would now be seeing a price-earnings ratio of only 10 in the second stock. Therefore, while the earnings had doubled, the price of the stock had remained the same. All this can be summarized in a basic investment rule. The further into the future profits will continue to grow, the higher the price-earnings ratio an investor can afford to pay. This rule, however, should be applied with great caution. It should never be forgotten that the actual variations in price-earnings ratio will result not from what will actually happen but from what the financial community currently believes will happen. In a period of general market optimism, a stock may sell at an extremely high price-earnings ratio because the financial community quite correctly envisages many years of great growth ahead. But many years will have to elapse before this growth is fully realized. The great growth that had been correctly discounted in the price-earnings ratio is likely to become undiscounted for a while, particularly if the company experiences the type of temporary setback that is not uncommon for even the best of companies. In times of general market pessimism, this kind of undiscounting of some of the very finest investments can reach rather extreme levels. When it does, it affords the patient investor with the ability to distinguish between current market image and true facts, some of the most attractive opportunities common stocks can offer for handsome long-term profits at relatively small risk. A rather colorful example of how sophisticated investors attempt to anticipate a changed investment community appraisal of a company occurred on March 13, 1974. The previous day, the New York Stock Exchange closing price of Motorola was 48 5/8. On March 13, the closing quotation was 60, a gain of almost 25%. What had happened was that after the close of the exchange on the 12th, an announcement was made that Motorola was getting out of the television business and was selling its U.S. television plants and inventory to Matsushita, a large Japanese manufacturer, for approximate book value. Now, it had been known generally that Motorola's television business was operating at a small loss and to that extent was draining the profits of the rest of the company's business. This of itself would warrant the news to cause some increase in the price of the shares, although hardly the degree of rise that actually occurred. Considerably more complex reasoning was the main motivation behind the buying. For some time, a considerable body of investors had believed that Motorola's profitable divisions, particularly its communications division, made this company one of the very few American electronics companies qualified as being of truly high-grade investment status. For example, Spencer Trask and Company had issued a report by security analyst Otis Bradley that discussed the investment merits of Motorola's communications division in considerable detail. This report took the unusual approach of calculating the current and estimated future price-earnings ratio not for Motorola's earnings as a whole but merely for this one division alone. The report compared the estimated sales volume and price-earnings ratio of just this one division with those of Hewlett-Packard and PerkinElmer, generally considered to be among the very finest of electronics companies from an investment standpoint. From the report, the inference could easily be drawn. This was not specifically stated that the investment quality of Motorola's communications division was such that it was worth, by itself, the then current price of Motorola shares, so that in effect, a buyer of the stock was getting all the other divisions for nothing. With this opinion about Motorola existing in some highly sophisticated places, what may be judged to have induced such eager buying on the Matsushita news? These Motorola enthusiasts had long known that many elements of the financial community were inclined to look with disfavor on the stock because of its television manufacturing image. Most of the financial community, upon hearing Motorola, first thought of television and secondly of semiconductors. At the time of the Matsushita announcement, Standard & Poor's stock guide, in the small amount of space available for listing the principal business of each company, described Motorola as radio and TV semiconductors. All of which, though not inaccurate, was misleading in that it suggested a different sort of company from what, in fact, Motorola really was, and completely overlooked the very important communications division, which at the time comprised almost half of the company. Some of those buying Motorola on the Matsushita news undoubtedly rushed in merely because the news was good and therefore could be expected to send the stock up. But there is reason to ascribe considerable buying to the belief that the financial community's appraisal of the company had been considerably less favorable than the facts warranted. The historical record was such that in the television business Motorola was regarded more as an also-ran than as an industry leader such as Zenith. With the television operations no longer blurring investors' vision of what else was there, a new image with a very much higher price-earnings ratio would arise. Were those who rushed in to pay these higher prices for Motorola wise in so doing? Not entirely. In subsequent weeks the shares lost the immediate gain so that a degree of patience would have paid. In downward markets, a change for the worse in the financial community's image of a company gets accepted far more quickly than a change for the better. Just the opposite is true in rising markets. Unfortunately for those who rushed in to buy Motorola on this news, the immediately ensuing weeks saw a sharp upturn in short-term interest rates which produced a downward trend in the general market and accentuated the widespread bear market psychology then prevailing. Perhaps another influence was also at work against those who snapped up Motorola shares overnight. This influence is one of the most subtle and dangerous in the entire field of investment and one against which even the most sophisticated investors must constantly be on guard. When for a long period of time a particular stock has been selling in a certain price range, say from a low of 38 to a high of 43, there is an almost irresistible tendency to attribute true value to this price level. Consequently, when, after the financial community has become thoroughly accustomed to this being the value of the stock, the appraisal changes and the stock, say, sinks to 24, all sorts of buyers who should know better rush in to buy. They jump to the conclusion that the stock must now be cheap. Yet if the fundamentals are bad enough, it may still be very high at 24. Conversely, as such a stock rises to, say, 50 or 60 or 70, the urge to sell and take a profit now that the stock is high becomes irresistible to many people. Giving in to this urge can be very costly. This is because the genuinely worthwhile profits in stock investing have come from holding the surprisingly large number of stocks that have gone up many times from their original cost. The only true test of whether a stock is cheap or high is not its current price in relation to some former price, no matter how accustomed we may have become to that former price, but whether the company's fundamentals are significantly more or less favorable than the current financial community appraisal of that stock. As previously mentioned, there is a third element of investment community appraisal that also must be considered along with its appraisal of the industry and of the particular company. Only after all three are blended together can a worthwhile judgment be reached as to whether a stock is cheap or high at any given time. This third appraisal is that of the outlook for stocks in general. To see the rather extreme effect such general market appraisals can have in certain periods and how far these views can vary from the facts, it may be well to review the two most extreme such appraisals of the century. Ridiculous as it may seem to us today, in the period from 1927 to 1929, the majority of the financial community actually believed we were in a new era. For years, earnings of most U.S. companies had been growing with monotonous regularity. Not only had serious business depressions become a thing of the past, but a great engineer and businessman, Herbert Hoover, had been elected president. His competence was expected to assure even greater prosperity from then on. In such circumstances, it seemed to many that it had become virtually impossible to lose by owning stocks, and many who wanted to cash in as much as possible on this sure thing bought on margin to obtain more shares than they could otherwise afford. We all know what happened when reality shattered this particular appraisal. The agony of the Great Depression and the bear market of 1929 to 1932 will be long remembered. Contrary in outlook, but similar in being spectacularly wrong, was the investment community's appraisal of common stocks as an investment vehicle in the 3 years from mid-1946 to mid-1949. Most companies' earnings were extremely pleasing. However, pursuant to the then current appraisal, stocks were selling at the lowest price-earnings ratios in many years. The financial community was saying that these earnings don't mean anything, that they were just temporary and would shrink sharply or disappear in the depression that must come. The financial community remembered that the Civil War had been followed by the Panic of 1873, which marked the onset of a very severe depression that lasted until 1879. Following World War I had come the even worse crash of 1929 and another 6 years of major depression. Since World War II had involved a vastly greater effort and therefore a greater distortion of the economy than World War I, it was assumed that an even bigger bear market and an even worse depression were on the horizon. As long as this appraisal lasted, most stocks were so much on the bargain counter that when it began to dawn on the investment community that this image was false and that no severe depression lay in wait, the foundations had been laid for one of the longest periods of rising stock prices in U.S. history. Since the bear market of 1972 to 1974 brought with it the only other time in this century when most price-earnings ratios were about as low as they were in the 1946 to 1949 period. The question obviously arises as to the soundness of the financial community's appraisal that brought this about. Are the fears engendering these historically low price-earnings ratios valid? Could this be another 1946 to 1949 all over again? An attempt will be made to throw some light on these matters in a later section of this book. There is a basic difference between the factors that affect changes in the general level of all stock prices and those that affect the relative price-earnings ratio of one stock compared to another within that general level. For reasons already discussed, the factors at any given moment that affect this relative price-earnings ratio of one stock to another are solely matters of the current image in the investment community of the particular company and the particular industry to which that company belongs. However, the level of stocks as a whole is not solely a matter of image but results partly from the financial community's current appraisal of the degree of attractiveness of common stocks and partly from a certain purely financial factor from the real world. This real-world factor is mainly involved with interest rates. When interest rates are high in either the long or short-term money markets, and even more so when they are high in both, there is a tendency for a larger part of the pool of investment capital to flow toward those markets, so the demand for stocks is less. Stocks may be sold to transfer funds to these markets. Conversely, when rates are low, funds flow out of those markets and into stocks. Therefore, higher interest rates tend to lower the level of all stocks and lower interest rates to raise that level. Similarly, when the public is in a mood to save a larger percentage of its income, more funds flow into the total capital pool and there is a more bullish pull on stock prices than when the pool of capital funds is rising more slowly. However, this is a much smaller influence than is the level of interest rates. An even smaller influence is the degree of fluctuation in new stock issues, which are a drain on the capital pool available to the stock market. The reason the new issue supply is not a bigger factor on the general level of stock prices is that when other influences cause stocks to be in favor, the new issue volume rises to take advantage of this situation. When common stock prices reach low levels, supply of new issues tends to diminish drastically. As a result, fluctuations in new issue volume are much more a result of other influences than an influencing factor themselves. This fourth dimension to stock investing might be summarized in this way. The price of any particular stock at any particular moment is determined by the current financial community appraisal of the particular company, of the industry it is in, and to some degree of the general level of stock prices. Determining whether at that moment the price of a stock is attractive, unattractive, or somewhere in between depends for the most part on the degree these appraisals vary from reality. However, to the extent that the general level of stock prices affects the total picture, it also depends somewhat on correctly estimating coming changes in certain purely financial factors, of which interest rates are by far the most important.